Jason, we've been talking about FHA mortgage delinquencies for a few weeks now, but I think this video, the one from the Real Estate Mindset, has some of the most compelling claims and data coming from someone named Melanie Wright. Apparently, she's been a servicer in the industry. She's like an expert on the back end of mortgages, and she seems like she's done a lot of research, and we're just going to react to the video for the audience. Okay, so this first clip is going to be them talking about how the Fed and Fannie Mae facilitated almost like a new age subprime situation. Pretty wild claim, pretty wild take. So let's see what they have to say.
They still own $2.1 trillion worth of mortgage-backed securities. So Melody, being that you are an expert on the back end, especially with the servicing, the defaults, the foreclosure, can you explain to the viewers how the Federal Reserve and Fannie Mae actually participated in and facilitated a new age of subprime loans?
Well, Travis, there is no way that rates would have gotten as low as they did if the Fed had not purchased those mortgage-backed securities at the clip that they did. It was just absolute insanity. And so essentially you had the Fed sort of bolstering speculation, bolstering, this market with really, really low interest rates and encouraging people to take on more debt than they could afford. And then on the other side of it, you have Fannie Mae, Freddie Mac, you have FHA, you have all of these programs that rely on the underwriting programs, the automated underwriting programs, which can be gamed like any program. You can figure out how to put in the right things to get an approval. But essentially, what they were doing is getting folks into loans they simply cannot afford, just as what happened previously. And so something you and I often talk about on your channel is that essentially the government stepped in to where the private market was during the GFC. And honestly, what I'm seeing is much worse. We can see, the degradation in the FHA portfolio, which comes first always. FHA really peaked delinquency around 2005. And then Fannie and Freddie did not peak delinquency until 2010. And so what you can see by that chart that you just put up on the screen that I sent you is that we are in a setup very similar to last time with the consumer overly burdened. And so they look like big jaws to me, Travis, and what you're going to see soon.
Okay, let's just pause it real quick. That was a lot of information, a lot of acronyms. So for viewers who are not really in the industry, or for people who they want to buy a house and they're trying to learn about the industry, but they don't know, they're not experts. We're talking about this every day, right? So FHA, Fannie Mae, Freddie Mac, all these words. Jason, since you're the mortgage expert, right? Could you give us a quick rundown? What is the difference between FHA, Fannie Mac, and Freddie? Fannie Mae and Freddie Mac.
So, Fannie and Freddie currently are government-sponsored entities. Simply put, without them buying the loans that we write and fund for you as a customer,
right,
we wouldn't be able to re-lend you that money because we don't have the capital to keep re-lending, right? Unless we sell it off. So everybody says direct lender this, direct lender that, but that direct lender is selling your conventional loan or FHA VA loan to Ginnie, Fannie, or Freddie.
Yeah, and FHA is just a program specifically for low income or first time homeowners, right? So it's a little bit easier to qualify. You could qualify at a 500 credit score as opposed to like
620 or higher for conventional in most cases.
Higher.
But yeah, it's for housing accessibility. Those programs were not designed to be like for top tier, like 750, 780, 800 FICO customers, right? That's what the conventional loans were for. And then the VA or FHA loan, it's for the people that have challenged credit or life circumstances. It's like, with how restrictive conventional loans can be when it comes down to the, like seasoning periods for like life events, like bankruptcies, foreclosures. Basically what happens with FHA loans is it gets cut in half. Same with VA loans. If you sacrificed and put your life at risk for our country, hell yeah, I'm 100% for getting you the best loan
Oh yeah,
possible so you can afford a home, you know? So it's like,
that's what happened after World War II.
mhm,
Basically all the homes in California and like the West Coast, that was because of post World War II. They made really, really accessible, affordable houses for veterans, and like
yeah. So I mean, to me
yeah.
so far, like doom and gloom, they're definitely, I don't know these two people very well, but they've definitely know how to play on emotion because tagging
Well,
this
let's
as
not let's not get
subprime,
there yet. Let's not
I don't know.
we're
You
not there
asked me
yet.
a
We're
question. Now I'm just about to rant. So
yeah, we're not there yet. We'll
okay,
give our opinions
I'll
later.
hold back for a
Oh,
minute. I'll hold back.
yeah.
Let's see where we go with this one.
Let's just talk. I mean, I just want to clarify because not
Yeah.
everyone knows. Like, we talk about FHA a lot, but it's just the Federal
Mhm.
Housing Administration. They have a program specifically for a low income to get people that have maybe lower credit scores into a house faster. Um, so technically it is a little bit risky, but the after the
It's a
Dodd-Frank
lot
Act,
risky. Basically,
it's a lot
it's you don't
riskier
fit
than.
in the normal bucket. So we have this program here to help you get back on your feet. So that's how I
Yeah.
see it, like FHA
And
loans.
the government says we guarantee that if
Mhm.
a lender or borrower defaults, they will step in to pay and insure the lender, right? So the lender has more incentive to come in and borrow to
Correct.
the lower income and lower credit
Exactly.
score borrowers, right?
Because if it
So,
wasn't backed
mhm,
or insured by the government, it would be very hard for a lender to lend those risky feature loans. Basically, when you have low FICO
right.
scores under 620 and you're in the 500s, frankly speaking, sorry if you're one of our audience members today, but when it comes to being in a 500 FICO score, you had a major life event. Either you had a chain of negative payment history or possibly a bankruptcy or foreclosure
Hmm.
event, short sale. Something happened where it was a major stumbling block in your life at that point. But it shouldn't be stopping you from putting a roof over your family's head, right? So that's
That
how I
was
see
the
it.
idea of it, right, right.
Mm-hmm.
Okay. So yeah, they're saying this chart is basically saying the Fannie Mae, which are conventional loans, right? Fannie Mae is still conventional.
Yes.
Yeah,
Mm-hmm.
Fannie Mae DTI levels and GSE delinquency. The orange is the great, um, I mean, government-sponsored entity delinquency rate is pretty
Mm-hmm.
low, and the
Yeah.
debt-to-income
Even though the
ratio,
DTIs are hovering right around like 36%, which is ideal for a
uh-huh.
Fannie loan. Mhm.
Well, it's
The blue
it
line is
looks
debt
like
to
it's
income ratio,
peaking.
so it's like 38. But typically, like lending guidelines, we want to be somewhere around 36 to 43%. So
Hmm.
it's in line. It makes sense. That's why the guidelines are there. That's why the delinquency rates are lower.
But it looks like what they're trying to present on this chart is that when like back here in 7 and 8, to income ratios were very high and that correlated with high delinquency rates. But there's some sort of lagging effect when it comes to 23, 24, where debt to income ratios are peaking, but we haven't seen the delinquency. So I think their point is in a couple more quarters, we're going to see this orange line shoot up to higher
I hope
delinquency
not.
rates. That's the picture they're painting here.
Yeah, it could be. If it everything does look like it's lagging by
Hmm.
at least 3 quarters or even 4 quarters, right?
Yeah, okay. So we have a couple more, like a minute left on this first clip, so let's just finish out what they have to say here.
Essentially, you're going to see the delinquencies start to go up here. And, we just heard recently from the Fed about what kind of impact those credit score impacts to credit scores we're going to have from those default student loan borrowers. And guys, we're seeing drops of 180 points and things like that. And so we're at a point where the consumer is overburdened. And very soon we're going to see it. The Fed puts out a quarterly kind of they use Experian and they track the health of that household, the health of household debt. And what we also know is that Affirm, which is a big buy now, pay later, started reporting to credit on April 1st.
Jason, Affirm, she mentioned Affirm. We talked about that
I
a
know you
few weeks
talked
ago.
about it. Talked about it.
Yeah.
We'll see how it affects your credit
No,
scores.
Yeah. Well, she said they started reporting April 1st.